And we can pass now to the next session, which is going to be on FinTech and financial solutions for retirement. The next session is going to be chaired by Aristides Protopapadakis, who is the founder and managing director of Systemic RM. Aristides is leading the business transformation and the global expansion of the firm. He's the soul of the firm. Aristides, thank you very much for being with us today and for chairing this very interesting session. So over to you. We cannot hear you, Aristides, you are muted.
Sorry, it should be okay now.
Yes.
So thank you, George, and hello from me. Today in this session, we have two highly esteemed speakers, Arun Murhalidar and Brière. So our first speaker is Arun Murhalidar. A few words about him today. Arun is the co-founder of Mcube Investment Technologies, and he's also the co-founder and CIO of Alpha Engine Global Investment Solutions. They put together finance with technology and data in order to improve returns and risk management. Arun's main focus is how his clients can get a return out of managing risk. He has written 4 books and articles with highly esteemed co-writers, including Franco Modigliani and Robert Merton. Now, he has a PhD in managerial economics from the Business School of MIT, Sloan. And his talk title for today is FinTech and Asset Management Solutions for Defined Contribution Plans. He will talk to us about a number of apps that he has seen in use in Brazil. Some of them have been developed by others, and also by himself, as I understood, and his son eventually, aiming to improve retirement security and risk tolerance analysis, among others, for about 15 minutes. Arun, I leave you talk to the rest.
Thank you so much, Aristides, and thank you for inviting me to this session. It's a real pleasure to be here. It's a little bit of a tough task because I'm going to be trying to cover 30 years of experience and mainly mistakes in 15 minutes. So that's how all my businesses came about, was trying to correct mistakes I'd made. Just very briefly on my background, actually, the thing that makes me most excited to be here was I was responsible for issuing the first Greek drachma bond by a foreign investor back in 1993. So literally 31 years ago today, I came to Athens to do the bond launch as well. So I'm quite happy to be here. Very briefly, I spent a lot of time at the World Bank issuing bonds, managing the pension fund. And as I said, I made a lot of mistakes. So I'm going to try to touch upon some of these issues because I think the move from DB to DC is very dangerous, something Professor Modigliani and I had warned about back in 1997. But I don't think we have a choice anymore. So I'm going to talk a little bit about the pension crisis and how we're transferring risk to individuals, which is a very dangerous thing. And I'll briefly talk about an innovation that Professor Merton and I advocated for, and Brazil has launched it, but there's no reason why Greece or any other European country, or any country for that matter, can't do it. And we've been talking to France, Italy, Spain, and other countries. Then I'll switch gears a little bit. That would be the discussion of the safe asset in DC retirement and how, if you have to achieve goals, think of managing a portfolio as really nothing more than trying to have a GPS, namely the traditional idea of mean variance optimization and a naive 60-40 portfolio to which you rebalance is fundamentally flawed theoretically. There's no basis to make any of those decisions. And so I've been advocating to my defined benefit clients that they can do much better by having a GPS, and the same principles could be applied to DC. So I'll try to do this very quickly with the assumption that basically as we move from DB to DC, the fact that most people can't do basic calculations about compounding and inflation means that when we transfer risk to them, there's going to be a problem at hand, right? So I just finished a study because, the question is kind of a little bit like Ludo's presentation. I did an analysis of about 61 large Dutch pension funds over the last 15 years to ask the question that even within defined benefit plans, when we had these sophisticated groups of people, and the Dutch pensions would be considered probably the most sophisticated globally, how confident can we be that they've actually outperformed their benchmarks, and what confidence do we have that they're skillful? And this is a performance measure I developed about 25 years ago. And the answer is practically, none, right? I think less than 20% of these Dutch pensions, with large resources, asset managers, all the famous people, seem to not be beating their benchmark with any reasonable degree of skill. And now if we take that structure and then say to them, by the way, now let's manage DC plans, but now the individual bears the risk, what are we going to get? We're going to get a massive problem, because now the individual bears the cost, whereas the risk taker, which is the institution on whose behalf these decisions are being made, are pretty clueless, right? So what that led me to is actually I was helping a lady in America try to design pension plans for what we call uncovered people. It's about 50% of the US population who don't have access to a pension plan, typically poor, unsophisticated. And I hadn't spent a lot of time managing DC assets. Most of my experience was in the DB world. But as I looked at the problem, we're transferring now a multi-generational challenge, which was what the DB world allowed us to do, to a single generation to get it right, a single lifetime, actually, not even a generation. You're asking people to make three really complex decisions: how much to save, how much to invest, how best to decumulate, what annuity to buy, what rebalancing. It's just so complicated that one of the best papers, which is Bodie, Merton, and Samuelson, is beautiful to read, but you need a PhD in physics to figure it out, right? So with people who can't do compounding and inflation, how are we going to get away with this? And then the other problem is very high cost. You buy your annuity from one party, you have to asset manage with somebody else. Who do you trust for good advice? And the products that are in the market, so for example, in America, we had this idiotic product called a target date fund, which changes the asset allocation because you're aging 1 year. And the government has said that if you put your staff in that product, you don't have a lawsuit. So what you have to do is really change the paradigm completely. And this is where my first innovation came from. And this is what I've done work with Professor Merton. Was essentially what we said is, if every asset in retirement is basically risky, because if you take Franco's life cycle hypothesis paper, you recall that he was trying to say, why do we save? And he said, we need retirement cash flows for consumption because we have income during our working life that we need to put aside for retirement. And if you compare every financial instrument currently in the market relative to these cash flows, they're all risky. So the T-bill and CAPM is very risky relative to these cash flows. A long duration bond has coupons that come up here and then pay off in 30 years, which means you need 61 more transactions to transfer it to the cash flow you need. Annuities are just complicated and terrible products. And so my idea was very simple. Thank God I'd worked for the structured bond side of the World Bank, which was, why don't governments issue a bond which pays you nothing till you get to retirement, and then let's say pays you 10 euros per year in real terms for 20 years, which is the average life expectancy of the economy. So rather than having the traditional coupon of 3 2/8 or 9 6/5 or whatever these crazy numbers were, why not just have it pay 10 euros a year or a month real? And therefore, this bond actually combines accumulation, compounding, inflation, and decumulation into one price. And the reason I chose 10 euros per month was, if the goal of your Uber driver is that they wanted to get, in addition to Social Security, maybe 1,000 additional euros per month, the goal was very simple: just buy 100 of these bonds. That's it. No more complicated math than calculating that, right? And the beauty of this instrument is it's low cost, it's low risk. It's just two questions: your date of retirement and additional real income you want from the bond. It's liquid. You can sell it back into the market or the secondary market. And if you die young, your kids inherit it. And it's a beautiful deal for governments because they're getting money today to fund infrastructure for the next 30 or 40 years, where all of Europe is struggling to fund green infrastructure. And, countries like Italy really have a problem with the ECB winding down its balance sheet, right? So this is a win-win. It's a no-brainer, but I can explain later on in Q&A why European governments are not thinking about this for a silly accounting reason, but we'll discuss that later on. But this was the basic idea. And what Brazil did was they've operated on a really beautiful app, and it's led to financial inclusion. So in a country like Greece or in France or in the Netherlands for self-employed people, this is a beautiful instrument. It's offered through what they call Treasury Direct, and I'll show you a picture of the app in a second. We've been working with them and continue to work with them. In a few months, they've managed to raise about 1.4 billion Rias from 75,000 investors off this app, 17,000 of whom had never purchased an instrument before. So this could be your Uber driver, this could be your maid, this could be the person who cuts your lawn, who currently are sort of excluded from financial markets because no large institution wants to take their account. And the beautiful thing is in Brazil, you can actually buy this in slices of 5 euros at a time. So you're an Uber driver, I give you a tip, you can take that 5 euro tip and actually buy a slice of retirement income. Okay, this is what the app looks like. Basically, you go onto the website, it's linked to your bank account, and you basically have to answer a few questions. And it says, here's my age, and I want to retire at a particular age. The additional income I want from these bonds is so much, and I have so many Brazilian real to invest today. And you press the button, and the software comes back and says, by the way, we found the best instrument for you. And if you buy it, basically, you achieve what you want. It's literally that simple. Okay, so we dumb down all of this complicated planning by saying, let's give people the safe asset in retirement, which would require 2 questions. And this way you can actually make all the poor people who are in the informal sector and currently excluded part of the formal sector. But if you make this bond available to institutional clients, then somebody like Marie and her firm can create much better intelligent products by dynamically allocating between stocks and bonds, given people's different risk preferences as well. So the idea was issue an institutional class, issue a retail class, allow this instrument to be the safe asset, and then you won't have the classic problems of having the uncertainty of how much am I going to get in retirement in terms of income, real income, right? Real guaranteed income, which today is not available. So that at the first level was one innovation I wanted to share with you, and how with a simple app you can do this. I also helped Brazil launch a bond to improve education, because financing education has the same challenge. And so Brazil has used the same infrastructure for this bond to issue an education bond, because again, now you can start to educate poor people by allowing them to save in these instruments. Okay, so this is basically what you get. And the yield and the price will change daily, but the cash flows, once they're locked in, are locked in for the guaranteed period that the bond offers. And it's available daily, so there's no issue at all as to when you can buy it, okay? Given that we have 15 minutes, I'm going to switch gears. I just came back from India, which is a very fascinating country. Talk about technology. The population has 1.4 billion people. And interestingly enough, they have close to 1 billion internet or mobile subscribers, lots of smartphones, but the amount of penetration in the financial markets is low, because it's typically been in the big, what we call tier 1 cities. And one of the suggestions I'm making to the country is, because there's low penetration of bonds, why not do selfies? Because that's easily enabled off an app. And actually, the Central Bank of India has a variation of this instrument that hasn't quite worked, because it's all paper-based. And now the question is, can they build the same instrument on an app, right? But the big question is, you're not going to get financial security by only investing in the safe asset. And so one of the things we were trying to show people is, in India right now, if you're following the markets, it's really booming. People are speculating like crazy. I have a WhatsApp group that every day I get recommendations of what to buy on the latest tip. And people are forgetting that drawdowns can ruin your sort of progress in terms of wealth and retirement income structure, right? But again, I've been a big proponent that naive rebalancing is silly. It has no intellectual basis to it. And so what people need to do is look at their portfolio as nothing more than a decision hierarchy, where in this case for these clients, I was trying to show them how they could break up their portfolio into Indian equities, bonds, and gold, the 3 major asset classes in India. And within equities, you could break it up into cash equities and mutual funds. But what we do once we come up with this decision tree is that every branch of the tree means that every day that the market moves, you're moving away from a strategic value. And if you don't do something, you're taking a bet. So not rebalancing is a bet. Rebalancing is a tactical bet. So all of investing is a tactical bet. And the only difference is, do you do dumb bets like rebalancing because a range was hit or it's the end of the quarter? Or you do something more intelligent where you take market information and allow yourself to make intelligent decisions. And unfortunately, I wasn't smart enough to call my business big data and AI when I started it 20 years ago. But basically, that's what we were doing. So this is actually what we feed into the sort of desktop of our clients. Today it's DB, but we're trying to take this into DC, which says based on all the ideas that you have that are in the public domain, which is amazing. And we've had clients who've made billions of dollars just applying this to their pension funds and implemented with futures. But based on all your ideas, it actually tells you how to tilt your portfolio in what I call smart management. And it can be done at all levels of the tree. And it can be driven by every possible idea that's in the public domain, which could be momentum, the level of price earnings ratios, the level of the VIX, oil, sentiment, gold, whatever you want. Once you have all these ideas built as simple rules, then they can get triggered automatically. And just like you're driving a car, you don't need to sort of worry about what's going on down the road. The software and the technology actually does it for you, right? Because I was sitting and running to Bloomberg and CNBC to try to figure out what to do with my portfolio every day. So I've been a strong advocate for dynamic management of assets intelligently, not naively. And so just to give you some examples of what we allow clients to do, either for the DC market or the DP market, is our software allows them to build these if-then statements, which is what all investing is. Every investment decision is an if-then statement in no more than 30 seconds with no technology background. And it tells you sort of what was the performance. And I've written a lot of papers on confidence and skill and risk-adjusted performance, etc. And then once you decide that these rules that you read in the public domain are either correct or wrong. So in fact, we found publications by large investment banks to be completely wrong when we actually tried to test their rules independently. Then the software actually would prompt you when any one of these are triggered. Okay? So it could be on the price of oil, it could be on momentum, it could be on whatever factor you want. And that's the whole idea. So this is how big data can sort of merge with what I would call augmented intelligence. I haven't seen AI systems do a good job. We worked on projects with the guys who landed the Mars rover. We worked with people at Watson. AI couldn't come up with better rules that we're able to do intelligently as human beings. But this is where FinTech can come in to help, right? So just to summarize, at a very macro level, I think European countries should issue, I shouldn't say can issue, they should issue selfies. And in fact, there's a first mover advantage for a country like Greece to do that because everybody else in the Eurozone could actually buy the Greek drachma, a Greek euro-based instrument because they don't have currency risk. So that's the beauty of Greece moving first. It leads to inclusion, and it's so beautiful, the app that the Brazilians have worked on. Brazil has proved it, so it's an easy thing to address. It addresses two key issues that Europe is facing, retirement security and green infrastructure. At a micro level, I think you definitely need some kind of a GPS, whether it's provided by institutions like Marie's or whether people build it themselves. There's avenues for both, and this is what we're exploring in India. And then at some point in Brazil as well, before we come to other countries. And I think once you have the transparency of all these decisions, it leads to better governance and hopefully better retirement outcomes. So Aristides, I hope I stayed within my time limit.
Yes, Arun, thank you very much. I heard with great interest. We'll take questions at the end, but I found very interesting this use of technology that you describe, which is quite simple. Generally, we think of FinTech as stuff which is rocket science addressed only to high-tech people, and your examples were really targeted to very simple individuals. And there's a good examples how FinTech can be used in the low end of the market, which is where the money is actually and where people need help.
Yeah, and actually, I'll just make one quick comment. I went from the World Bank Pension Fund to managing 20 billion at JP Morgan. And literally all my Excel spreadsheets were nothing more complicated than that, right? So JP Morgan earned a substantial fee. And that's when the light bulb went off in my head that if everything was an if-then statement, whether it's hiring a mutual fund or currency or an individual security, why not, empower people to do that with software where you just have the drop down and the templates are already pre-structured, right? So we've actually got the one that my son is actually launching in India has more gamification targeted to the younger audience, which takes what I showed you and makes it even simpler and makes it into a game as well, because that's how we'll get the young people into financial literacy, not by trying to teach them about compounding and inflation.
Precisely. Thank you very much, Arun.
Thank you.
Now let's move to our next speaker, which is Marie Brière. Marie is Head of Investor Intelligence and Academic Partnership at Amundi Institute. She's also a Senior Associate Researcher in a couple of universities like Paris Dauphine University and Université Libre de Bruxelles, which is the university I graduated from, so I'm glad to see that name here. Marie conducts interesting research on household investment and pension decisions, which lead to the design of investment solutions for individual investors. She also helps institutional investors reach strategic decisions. She's a chairman and member of a number of highly esteemed scientific committees. Among others, she received the Markowitz Award for her article on sovereign wealth and risk management. Her talk title today is Robo-Advising for Pensions and the role of artificial intelligence in that. I'm very interested to hear what she will have to say about the role of AI, which is a hot topic today in all sorts of industries, not only financial. And she will talk to us about other things in there, like individual investors' biases and other interesting things, which I will let her cover. Go ahead, Marie, 15 minutes, please.
Thank you very much, Aristides. We're very happy to be here. So I would like to thank the organizers for having me here. Let me share immediately my slides. Can you see it?
Yes.
All right. Yeah, so I'm going to talk about robo-advising, and very happy that Arun made the first speech, because a lot of the concepts he covered will be completely related to what I'm going to talk here. So I think we share a lot of ideas here. And so the general context, and you touched on that, Arun, is the fact that individuals are more and more responsible for their pension savings decisions. So you mentioned the shift from DB to DC, but also in countries like France, where we have a major pay-as-you-go pension system, we see a decrease in the benefits, and third pillar pension is becoming much more important. So the question is, can technology help in that concept, in that context? And robo-advisors in particular have a lot of advantages, and I would like to see how they can improve pension savings decision, and what also are the remaining challenges, and in particular, what the role for AI. So how can robo-advisors improve investment decisions? You say that, Aristide, that individual investors, they are having a lot of investment biases. And when we look at the investment decisions that they take, you can see a lot of these biases from, for example, the low participation to the stock market, insufficient diversification, the domestic bias is also prominent, and moreover, they have limited attention. So they do not spend so much time looking at their finance. And when they observe their portfolio, it's often more in rising markets. That's what we call the ostrich effect, than in downwards markets. So there are a lot of biases that lead to investment mistakes. And in particular, that's particularly true for people with low financial literacy. So that's also a big issue here. Can technology help? So that's where robo-advisors come. Robo-advisors, you know the technology, and it's an online platform that provides financial advice or allows the automated management of a portfolio of assets. There is a direct digital relationship with an interface that is intuitive and gives access to a large choice of funds and ETFs typically. And asset allocation, so the choice of the strategic asset allocation and rebalancing is done typically at limited cost. The global robo-advice market is relatively small. It's 1.5 trillion. It's projected to grow. Has been disappointing a little bit, I would say, in the growth projections. But for example, Statista projects it to be about 2.3 trillion in 2027. What does concretely robo-advisors do? It first helps you define your investment goals. Then it assesses your personal preferences through a questionnaire. It then constructs and communicates an optimal investment strategy. And then there are either alerts sent or the portfolio is automatically rebalanced. I will come back on that because we see the two types of robo-advisors when the asset allocation drifts from the targeted asset allocation. There are various types of portfolio optimization techniques that are used. I'm not going to enter the detail. What's interesting are these two types of robo-advisors that we see developing right now. One that the European Parliament calls personalized robo-advice, where the software provides advice, but the client makes the final investment decision. So alerts are sent, but it's the client that is ultimately taking the decision. The clients remain in control. The other type of robo-advisor is what we call managed account, where the software automates everything. So the rebalancing is done automatically, and the robo-advisor doesn't need client approval for making investment decisions. We'll come back on that because there is an open question of what would be the optimal type of robo-advisors to design in the future. So I will come back on that. What are the promises of robo-advisors that are particularly interesting in the pension space? First, it's improved clients' knowledge and personalization, so that's quite important. There is a detailed questionnaire and which allows to gather information on the personal details of the client. Second promise is a reduced bias in clients' treatment. Even if in practice, when we look at the take-up of robo-advisory services, the robots are mainly used by young people, so there is still a bias in practice. And the last type of promise is financial inclusion. I mentioned that, and I think it's very important. By reducing the cost, the new technology can reach people that are traditionally unserved by human advice, basically. They typically require lower initial capital, they charge lower fees, so they are much more affordable for people that have lower means. I would like to talk about an impact analysis we did at Amundi on the introduction of our robo-advisor on employee savings plans. So Amundi is a very big player in employee savings plans in France. We have about 50% of market share. Employee savings plans are a little bit like the 401k in the US. So firms offer their employees a possibility to save for retirement in savings plan, and people receive money from their employer that they can allocate freely in a menu of funds. And what the robo-advisor that we introduced propose is an investment advice and a way to dynamically manage the assets that the people save in these plans. What we did is kind of treatment analysis. So we compared people that took the robo-advisor, about 15,000 clients, to different random samples of clients that didn't take the robo-advisor. Various kinds, I'm not going to enter the detail, but we looked at robo-curious, so people that were interested by the service but didn't finally take it, people that were not exposed to the robo because their company didn't consider taking the service for their employees. So many control groups. And then we looked at the impact in a what we call diff in diff approach. So like in medicine, when we look at the impact of being treated, so here not being treated by a pill, but being treated by a robo-advisor, compared to control groups of people that were not having access to this kind of advice. I would like to share some of the highlights of, we have several research papers on that, and I would like to summarize what we're finding on the impact of this treatment. And there are 5 important results to my view. The first one is that the robo leads to increased risk-taking. So with robo-advisor, And it's quite a striking result in a way. People take more risk. People are more willing to invest in equities. In average, about 9% more total exposure to equities compared to an average exposure, which is about 13%, which is quite low in France. So it's quite substantial if you think in relative terms. So it's an open question. Why are people willing to take more risk when they are followed by a robo-advisor? Maybe it's a question of confidence. They feel more comfortable when they are followed by, even if it's an algorithm advisor. Second thing we noticed and we measured is that the robo-advisor introduced dynamic rebalancing, something that people left alone never do. So people do not rebalance their portfolio. They are typically very passive. So here the robo-advisor sends alerts, and then the client is offered the possibility to rebalance its portfolio to come back to what is supposed to be the strategic asset allocation. And we found that people in average reacted quite well to the alerts, even if they were not obliged to follow the recommendation. They were quite good pupils, and they tended to follow the recommendations. Not all the time, I will come back on that, but they tended to introduce a rebalancing strategy. All in all, that had a positive impact on performance that we measured to be about 3% annually, 1/3 due to the improved efficiency of the asset allocation, about 2/3 due to the introduction of dynamic rebalancing. Fourth result, we found that the robo-advisor had an impact on financial inclusion. So that's very important to me. We found that first, the robo attracted all types of investors, slight bias for male, but people that had low income, basically, and low wealth were also attracted to the robo-advisor. And we found, and that's a very important result, that the impact on equity exposure and also on performance was higher for people that had smaller portfolio. So less wealthy were more impacted by the improvement in return. The last result we found is that the cost of letting people choose, because I told you there are these two types of robo-advisors. Either you automate everything because you think people are not able to make decisions, so they will implement their own biases, so it's better to automatize everything. Or you think that it's good to send alerts because maybe through the alerts, people will pay attention to their plan, and maybe also through that they can learn. It can also improve financial education. What we did is compare the performance of these people to a counterfactual performance of what they would have achieved if they had perfectly rebalanced exactly at the time the alerts were sent. Of course, they were not so good pupils, they were sometimes waiting, sometimes not implementing the alerts. But we found that on average, the cost of letting people in control was small. It's about 5 basis points in average. So it's quite small compared to the improvement in performance, which was about 3%. Of course, some people did much better. Some people did much worse than the robo-advisor. But if you look in aggregate, in a welfare perspective, the cost of letting people choose was very, very small. So in the remaining minutes I have, I would like to discuss some of the remaining challenges for robo-advisors, and in particular, Aristides, what the role for AI in the development of robo-advisors. There are a couple of questions that I think we need to collectively address and think very carefully about. The first question is personalization and how far we should go into personalization. It's great to personalize because, of course, and Arun will certainly, he worked with Bob Merton, so he will not contradict me. I mean, the optimal asset allocation depends on a number of characteristics, labor income risk, all that. So we know it's good to personalize and take all these characteristics and features into account. One big question in robo-advice is some of these characteristics are not measured very precisely. Think about even risk aversion. People do not know what their risk aversion. The funny thing is that if you look at robo-advisors, they change their minds, so they change their risk profile through time. So maybe because of personal circumstances, but also because they change their mind, I don't know. So I think we have to be very, very careful of estimation, parameter estimation errors, and not introduce too much personalization with parameters that are completely unknown even by the client itself. The second question is a question of algorithm aversion and trust. So a lot of people do not trust algorithms. So I like this HSBC survey that was asking people in the street about their trust in algorithms, and then the trust was very low, and 90% of people say they would use an horoscope to guide investment choices, while they would not use an algorithm. So I think we have to be very, very careful with that. And the algorithm complexity is particularly painful for people with low financial capabilities. How to build trust? There are several ways. The first is control. And you trust much more an algorithm that you can control. So you can play with the parameters or validate the final decision. So I think that's something which is very, very important. Another factor of trust is explainability. If you have your algorithm is explained, is understandable for the client, that brings also trust. So that leads me to the final question, which is what should be the role of AI in robot advisory services? And if you look at the big robot advisors that are here in the market, it's challenging to see that they are not using so much AI. So they typically rely on simple algorithms. So traditional portfolio optimization techniques, and there is not so much fancy machine learning type of stuff. Why is this the case? Might be regulation, and in particular, some regulation, particularly in Europe, is asking for explainability. There is a right to explanation, etc. So it might be complicated to explain the client a complicated algorithm. It might be also questions of client's trust. And that calls for the question of, if we were to introduce more AI, what should it be? Should it be more automation, more data, more complex models in profiling? We've seen some attempts in that. In AI recommendation systems, there are also some attempts in that. I'm not so sure. And what I would personally recommend is what we call explainable AI. So algorithms that are easily interpreted and evaluated, because they can, through that, improve financial literacy. And also AI for efficient human-robot interaction. So I believe very strongly in that. Chatbots, AI for chatbots, AI to track investors' decision and then making them avoid investment mistakes. There is a nice project by Schwab, which is called Project Bear, that uses AI to predict when investors are getting nervous. So when they connect a lot on their platform, when you see they are about to sell in bad market conditions, you can use AI for that. And then based on that, a human advisor calls you and tells you, be careful, no worry, if you can't wait before selling, etc. So that is the kind of AI which I think we would need. So which is allowing efficient human-robot interactions. So with that, I would like to conclude. So I think robo-advisors are very useful tools for pension beneficiaries on the design of the strategic asset allocation, on the design of optimal dynamic rebalancing strategy, as Arun has been stressing with his product. Should robots become complements or substitutes of human decision? I think it's still an open question. We have these two models, target date funds and life cycle funds versus robo-advisors. Keeping people in the loop might have advantages, and that's what, and we saw in our own research that there is little cost of letting people in control, and people can learn through the human-robot interaction. So I think we should not understress that. There is a large potential for generative AI to organize nice human-robot interactions where people can learn, and through that we can improve financial literacy. I will conclude with that. A couple of references on the articles we published on robo-advisors, and I'm looking forward to your questions. Thank you very much.
Thank you very much, Marie, for your very, very interesting talk. I'd like to say a few things, but unfortunately we are running out of time. I am advised here. A couple of questions. One question that I see here is for Arun. It concerns the retirement bond. Somebody asked here, what's the main difference? Is it finally the same with receiving pension? And how is the inflation adjustment actually take place? And do you see a real difference in there finally with between retirement bond and receiving pension?
So it's meant to be very similar to receiving a pension. So in fact, in Brazil, it actually goes into your bank account the same day your social security payment goes in. So essentially, you're buying the same stream. The only difference, if you recall, is it only pays for 20 years. So it's a fixed term. It doesn't have the life longevity hedge as well. And we can talk about how this bond actually can solve that problem very easily as well. But it was designed to actually look exactly like a pension. So in buying the bond, you're buying a pension. In fact, the best thing we can do in countries where you have a lot of informal workers is the overhead structure of having a pension system is expensive. Essentially, buying this bond means you're buying a pension, which at zero cost. So you get rid of all the overhead. I sit on the board of $100 billion US pension with the DC plan, and I'm trying to, sort of nudge them towards getting rid of the target date fund in favor of something more like this, where there is income certainty. So that's basically the idea here, is to try to keep it as close as possible to a pension, but with complete liquidity, which means if you change your mind and you want to retire on a different date, you can sell out your bond for this date and buy the other one. So you're going to have all the flex. It's like an individual DB. If you want to think of it as that, that was my design idea, was create an individual DB. And as I said, we can talk about the life piece later on, but that's a very small problem at a macro level.
Okay. Thank you, Arun. And for Marie, there are a couple of questions, but I will make it into one due to time pressure. So finally, the question is, robo-advising, the way you presented it, maybe resembles to momentum strategy a lot. So people ask, why not simply invest in an ETF that follows a momentum strategy? And what main differences do you see?
I think it's quite different from momentum, because the way it is implemented in a lot of robo-advisors is rebalancing towards a strategic asset allocation. So that, I would say, the opposite of momentum, because you buy when the markets are low and you sell when the markets are high. So that's the kind of strategies that robo-advisors are typically implementing. So I think I need to be clear on that. That the way it is, the type of dynamic rebalancing that is done is that way.
Okay. Thank you very much, Marie. This ends our current session on FinTech and innovation in retirement solutions. I pass the word to George.
Thank you, Aristides. Thank you for sharing this session so efficiently, and many thanks to Arun and Marie for their very insightful presentations and comments. I wish we had more time. Actually, we could have spent the entire day on FinTech and solutions for retirement. So, but the next session also promises to be very exciting as well. So